Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks and futures trade higher as Iran and Israel refrain from further escalation, at least for now. Investors look ahead to earnings from the Magnificent Seven and from Europe's banks. US aid passes the House. Ukraine's President Volodymyr Zelensky says billions of dollars in new funding could help Kyiv retake the initiative against Russian forces. Plus, Tesla slashes prices once again amid a drop in sales and its stock price. As the headaches pile up for Elon Musk, eyes turn to the EV maker's crucial earnings report. That is tomorrow. Let's check in on these markets then. Unwinding some of those risk-off safe haven moves, a little bit more optimism then percolating through these markets. And yes, there is a focus now, a shift, a look ahead to the earnings season. 40% of the S&P coming through with earnings this week. The Mag 7, about half of those companies, starting, of course, with Tesla, as we said, on Tuesday. And then you have the data out of the US, the growth data, and, of course, the Fed's preferred inflation gauge. That comes out on Friday. Will it reinforce what we've been hearing about Fed officials, or from Fed officials, around the need for higher for longer around the interest rate environment? Currently, futures in Europe pointing to gains then, 0.3%. We're looking at S&P futures as well, up 0.3%. NASDAQ futures pointing higher by 0.5. The context is, of course, that the NASDAQ 100 dropped around 2%, a little over 2% on Friday. Nvidia was crushed as well, falling about 10% by the end of the close on Friday. The NASDAQ 100 dropping the worst week, in fact, it's had since November of 2022. Let's reflect as well, flip the board and see how some of the moves and the unwind around some of those safe haven moves. So, for example, gold is a little softer in the session so far today. The US 2-year crossing back above 5%. It's a really big week as well for the auctions. So we'll see the appetite that comes through for the 2s, 5s and 7s as a lot of debt is auctioned off in the US, and a test then of whether or not yields are looking a little peaky at these levels. Euro dollar at 106, largely as a result, a little bit of softness coming through for the US dollar. So the single currency at 106. There's the little softness coming through for gold then, unwinding again that move into that risk haven, down almost a full 1 percentage point at 2,369 per troy ounce. Brent also softer in the session, down 0.8%. We'll be unpacking that story with Amrita in the next 10 minutes. The outlook for crude WTI as well. Let's cross over to Asia now, where Avril standing by in Singapore for a deep dive on these Asian markets. Good morning, Avril. What's standing out to you?
Yeah, we're seeing that similar play over here in the Asia Pacific, where there's a bit of an unwinding of the safe haven bets, but that relief rally among stocks is underway. That being said, it was more pronounced from early on in the session. The Nikkei now pairing some of the earlier gains. The CSI 300 has also flipped into negative territory. The Hang Seng, though, one of the standout performers today, as Chinese authorities have unveiled measures to boost the standing of Hong Kong as a financial hub, and this includes adding REITs. That being said, on the TAIEX, we're seeing that negative sentiment coming through, no thanks to that Nvidia tumble last week. And among the APEC semiconductor, AI-related stocks, those are the ones that are dragging the region's benchmark lower today. And it's crucial for a week where we're seeing the big tech earnings coming up along with US data. So I'll get to that in a bit, but let's flip the board, because it's not just that we're watching this week. At the end of the week, we're also going to see the BOJ potentially hold rates after that historic hike last month. And I'll get to what we're seeing on the bonds potentially, but let's take a look at this chart, which shows you just how the AI theme might be unwinding. TSMC, this is a stock that has lost more than $100 billion of market value in the span of about a week. And this is also a chart that shows you the volume of put options and at the end of last week, it actually spiked to the highest level since January, and our colleagues in the newsroom have pointed out that this is potentially the sign of how options traders are dealing with this bearish wave of TSMC. Let's also take a look at what we're seeing in Japan bonds if we can. As I said earlier, it's about the BOJ at the end of the week and how the Japanese currency has really weakened to an extent that it could shift the inflation outlook for the country. This could mean that the BOJ, potentially announces the start of quantitative tightening, and this could be from the cutting of bond purchases. So this could prompt further upward pressure on Japanese bonds, Tom.
OK, Avril Hong in Singapore with a breakdown of the Asian markets. Thank you very much indeed. Now to the domestic politics of the US and how that is filtered across internationally, of course. The US Senate expected to pass $95 billion in fresh aid for Ukraine, Israel and Taiwan this week after the end of 6 months of political deadlock in the House.
This aid will strengthen Ukraine. We did lose the initiative there. Now we have all the chance to stabilize the situation and to overtake the initiative.
OK, let's bring in Bloomberg anchor Kriti Gupta for the details on this. Kriti, it seems like it's a done deal. It has to get to the President's desk, of course. The Senate is likely and expected to approve it. Could happen this week. Big, of course, for Ukraine. What is in the package, then?
Well, a lot for Ukraine, to your point. $61 billion of aid for Ukraine. But it's not just Ukraine. It's Israel and Gaza as well. More defense, a kind of replenishment for the Israeli forces against Iran specifically. That's specifically worded in the agreement, as is about $9 billion of aid specifically for Gaza. Again, the wording is really important here because Democrats have been pushing for this. And in terms of the makeup of this bill as well, this is a bipartisan bill that was seeing a lot of pressure from the far right as well. So Speaker Johnson potentially in the crosshairs from that, but being able to pass this through. There's also money going towards Taiwan and other of its Indo-Pacific allies. So think about $8 billion, some of it going to submarine infrastructure and things development there, for example. We're getting into the nitty-gritty, but the reason this matters is because Pacific Command, the U.S. naval forces basically, are historically underfunded and have been. It's the least funded part of the entire defense budget for the United States. And that's why the summit that we saw a couple weeks ago with Japan and the Philippines is so important. It's because that is kind of helping the United States have that footprint there in a way that they can't really manage on their own.
OK, we'll certainly watch for any Chinese reaction to that additional funding for Taiwan. To Ukraine, though, the impact, what is it likely to be, this $61 billion that you outlined for us in terms of the military resilience of Ukraine?
Well, let me break it down here because there are a couple of different pieces of it, but the key pieces are $14 billion of that replenishment. So U.S. defense systems in particular. We're talking about air warfare, drones, et cetera, things like that. Then even about $13 billion of actual stockpiles rearmament. So that is actual weapons that are going to fighters on the ground, the frontline troops, about $13 billion there, about $7 billion for U.S. operations there. So that includes whatever kind of the U.S. Intelligence forces, et cetera. That's where that funding goes, as well as $9.5 billion in forgivable loans. And this is important. It's forgivable loans, which, by the way, was first brought up by President Trump and then now reimposed by President Biden. If indeed President Biden is elected to a second term, it is forgivable, and he intends to kind of clear the debt, if you will, for Ukraine. But what's important is this is also the turning point for the front line of Ukraine right now. And in the last couple of weeks before this aid was passed through, the expectation was that Russia was kind of making far more advancements than expected. Vladimir Zelensky overnight or over the weekend really saying that this is going to change the game in terms of getting that aid to the front lines and pushing back on that Russian offensive.
Kriti Gupta, thank you very much indeed on the details around the funding package that is coming through the US and the expected impact then on the ground in Ukraine. Focus this week shifting to company earnings. We'll switch focus now away from the geopolitics to the earnings story. Some of the biggest names, of course, in global tech set to report. The so-called Magnificent Seven's numbers arrive at a crucial time as investors look for an AI-powered rebound in stocks. And it is not just earnings. The Fed's preferred inflation gauge also coming out this week. As I mentioned, for more, let's bring in Bloomberg's MLive Strategies, Mark Cranfield. Mark, then how are cross-asset risks lying? How are they lining up this week? When we think about the big tech earnings, the expectation around that AI catalyst in a week where we also, of course, keep a finger on the gauge of inflation.
It's huge. You can't underestimate this week at all, especially as the Nasdaq 100 is down about 8% or so from the highs we saw in March. So for a lot of relative value people, they would see that as being a pretty good entry point to get back into what has been a very strong bull market over the past couple of years, providing that the earnings come in on at least as good as expectations, hopefully even a little bit better. So you can imagine if we get a set of earnings which are a bit inconclusive or even, let's say, slightly below par, things could really look very shaky because those people who've been holding on, even though the market's down 8%, may decide to give up, especially as Nvidia, we've still got about another month until they report. And we've already heard earlier in the report that Nvidia had a very bad finish to last week, dropping 10% in one day. So the market clearly is nervous. So really expectations are very high. We need a pretty smooth week in terms of getting through, and there's so many people reporting here. It wouldn't be too much for somebody to make a mistake along the way here. So really investors are on tenterhooks, and as you mentioned earlier, it's a massive week for Treasury refunding as well. So we've got 2-year yields sitting around 5% now. They could easily go a bit higher during the week.
Yeah, and some of that nervousness, as you say, and some of the yield action, of course, linked to what's happening with inflation, PCE coming out towards the end of the week, the expected number coming in at 2.6%. That is the forecast. We'll see what the actual number is, of course. Tying into expectations then of stronger dollar, is the euro, when we link all of that to the euro and the eurozone, Mark, is the euro the weak currency on this front? Is the most vulnerable major currency when it comes to dollar strength, particularly as we hear increasingly dovish commentary from ECB officials?
Yeah, certainly that's what traders are thinking here, because they're mapping out the future rate cut expectations between the ECB, Bank of England, and the Fed, and obviously they've got in the background you've got the Bank of Japan as well. So at the moment, most traders are thinking that the ECB is going to do more rate cuts this year than either the Fed or the Bank of England, which obviously puts the euro on the defensive. Now, of course, so far nobody has moved at all apart from the Bank of Japan, but it's going to be very hard for the European Central Bank to walk back expectations of June. We've already heard Christine Lagarde be pretty forthright in suggesting that is when the first interest rate cut is coming. We've had more European Central Bank speakers since then agreeing with her. Mr. Villeroy over the weekend as well, adding his voice in there, saying that oil prices are not going to get in the way of the ECB lowering rates as well. So it would need a lot for people to think that the ECB is not going to happen in June. But who comes next? And how much of the time gap is there between them and the cut either from the Bank of England or from the Federal Reserve? That's what traders are trying to gauge. And for now, they're giving a little bit of benefit of the doubt that the ECB won't be too far ahead of the others. But if we see that gap get wider, if the Fed even goes, say, to the fourth quarter, it could be very vulnerable for the euro. He will be the currency most at risk within the G10 group.
OK, MLive strategist Mark Grenfell, brilliant analysis once again on a big week, as he says, a major week for these markets, and of course the implications for the euro as we look ahead to that inflation print out of the US and any further commentary from ECB officials. The week ahead then, of course, earnings front and centre, as Mark was outlining for us. US earnings, European earnings. On the US front, again, 40% of the S&P reporting about half of the Magnificent Seven. And then, of course, you have the likes of Lloyds Banking Group, Heineken, of course, which has that global footprint for Europe. And then Deutsche Bank, Barclays, BNP, so a big week for European lenders. And on Friday, NatWest here in the UK, a gauge maybe of the health of the real estate market here. And Rémy Cointreau, of course, the French luxury drinks maker. We're also going to be thinking about European PMIs as well. So building out the picture as we hear from the likes of Germany's Olaf Scholz and indeed the IMF suggesting that maybe Germany's economy is looking a little bit sounder, a little bit stronger, of course, from a low base. Whether or not the PMIs build out that picture, that detail coming out on Tuesday. Coming up, as the US House passes new sanctions on Iran's oil sector, we're going to look at the impact on the market for crude. Amrita Sen from Energy Aspects joins us next for the analysis. This is Bloomberg. Welcome back. Now, Israel's Prime Minister Benjamin Netanyahu has condemned a reported US plan to sanction an ultra-Orthodox army unit over alleged human rights abuses in the West Bank. According to Axios, the Biden administration is planning to announce the measures within a matter of days. Blacklisting the battalion would prohibit it from receiving US military equipment or training. Now, the US House, meanwhile, has passed new sanctions on Iran's oil sector as part of a foreign aid package. The legislation broadens measures to include foreign ports, vessels and refineries that knowingly process or ship Iranian crude in violation of existing US sanctions. Let's bring in at this point Amrita Sen, then, founder and director of research at Energy Aspects. Amrita, a great joy and pleasure to have you here in the studio to kick things off this Monday. Let's start with the Iranian oil sanctions story then. Does it take material Iranian barrels out of the market, do you think?
I think in theory it could have an impact. I think what I'm concerned about is the only country that buys Iranian oil is China. And the only refineries within China, or mostly, that buy Iranian oil are what we would call the teapots, the independent refiners. They're not in the U.S. financial system. They don't use U.S. dollars. So it's not that easy for the U.S. to enforce anything on them. They can continue to buy it, and they will. Maybe we get a little bit off, like Iran has been exporting over 1 million barrels per day on average, about 1.2 to 1.5. You could potentially get 200,000 to 500,000 lower, but about 1 million will still flow into China.
OK, so 2,000 to 5,000 lower, but arguably, given the size and scope of the Chinese market and the Chinese buying demand, that continues. There's been a lot of reporting, a lot of suggestion that maybe up until recent events, the enforcement by the US of existing sanctions on Iran had been relaxed. The US and the Biden administration pushed back on that. They deny that that's what's been happening. Have you been seeing that, and has that now started to reverse the impact of the lack of enforcement of some of these sanctions?
Oh, I mean, look, the lack of enforcement is why Iranian exports last year went up by about 600,000 barrels per day. It was a pretty consistent sub 1 million, and now it's kind of gone up that much. The Biden administration continues to officially and unofficially deny it, but the numbers speak for itself. But I think so far we haven't seen any stricter enforcement. I think it's been more talk. Let's see with the new bill and like the new focus with what's going on in Israel-Iran, whether the U.S. actually enforces it. But what I really want to highlight is that this is a U.S. election year. So let's not kid ourselves. I think all sanctions are sanctions on paper. With anything that remotely causes oil prices to go up, I just don't see myself believing that they're going to enforce it strongly. OK,
very interesting. What is the geopolitical risk premium that's priced into oil at this point?
Not very much. We've had a correction, right? So I think the market has been expecting a potential escalation. We haven't seen it. It's been quite calibrated, measured, kind of on both sides, both Israel and Iran. That's why prices have been coming off a little bit. We're not expecting massive downside, but we are expecting small downside in prices. Physically, this is the weakest period for oil anyways. We're very bullish this summer, but right here, right now, I think, things will probably calm down a little bit.
What underpins that bullish view when it comes to the summer? And is that the demand story? Is it the supply story? Is it the component?
I mean, it's a combination. First quarter, we didn't build inventories, which is huge. Usually, we always build stocks. This Q1 was a counter-seasonal draw. We are building now, which is what it should be, April and May. June onwards, we get the decline in stocks. And, we are calling for over 2 million barrels per day of inventory drawdown in Q3, even with our assumption that OPEC might bring back volumes very gradually.
How much is there evidence still? Is the compliance there? Is the discipline there still within OPEC Plus? Are they holding the line on these cuts?
I mean, OPEC Plus as a whole, yes. There will be a few countries, you guys report it all the time. I mean, there's always a few culprits where compliance slips from time to time, but Saudi Arabia is very much leading from the front, right? And it tries to always get the group together in terms of cohesion. Overall, OPEC compliance remains very high and definitely been well over a lot of people have been talking about 50, 60%. It's well above that.
Bloomberg dollar index up about 4% year to date. At what level does the strong dollar start to crimp that demand?
Yeah, and I think for me, it's not just the strong dollar. If you look at the overall backdrop for risk assets right now with what Treasury yields are doing, that's also why I'm saying oil prices probably do soften a little bit in the near term. It's not necessarily all kind of green and going for oil. And I do think, right now the dollar is okay versus, where oil demand is and it should be. But if the dollar continues to rise through the course of this year, a lot of emerging market then starts to feel the pressure.
And on emerging markets, how well supplied is China at this point, if we put it into the EM category?
Yeah, it's a big question. I'm actually heading off there tonight, so okay. I'll probably have more for you when I get back. But I think for me, the biggest or the most interesting thing on China has been they have been buying quite a bit for their strategic reserves. So just like the U.S. is depleting their reserves, China has been buying it. And I think at $90 oil, they paused a little bit. Now the question is if people pull back, does that come back? I think China has been concerned about what's going on. Underlying demand, like end-user demand, is pretty solid, especially for gasoline and jet. People are traveling around. The weakness is in diesel. The economy still isn't doing great. So it's a different composition. We're seeing much more driving and flying by people, but not really a manufacturing China, which is what we're all used to.
A little bit of near-term softness is what you see. A little bit more bullishness when it comes to the summer. 86.53 on Brent now. Give us your forecast on Brent or WTI by year end then.
So we've always called this year for Brent to be $85 average. So we were very much in the camp that we'll trade well above 90s in the summer. And right now we'll be in the 80s. So we came a little bit, it's come a little bit early, but we're still holding that view because, again, it goes back to, we tend to talk about geopolitics from the bullish side, but with a US election, I think they're going to try and tamp down the bullishness as we approach the elections. That's our biggest concern in terms of the bullishness. Of course, look, if you get an outage because of geopolitics, we're going to go much higher than
I think
that.
the US electoral component is really, really fascinating. Amrita Sen, thank you very much indeed for carving some time out of your busy schedule to give us the analysis on these oil markets. Amrita Sen, founder and director of research at Energy Aspects. Coming up, Ghana's bonds jump as the country's finance minister says he expects a draft agreement from its official creditors by May. We bring you the details of that story next. This is Bloomberg. Welcome back. Happy Monday. Let's get an update now on Ghana's debt situation. The country's finance minister says he expects a draft agreement with official creditors next month, following the agreement in principle reached in January. Let's get more then from Bloomberg's Jennifer Dabasaja in Joburg, standing by for us with the details. Jen, what is the latest then on Ghana's debt restructure? How significant is this?
This is significant, Tom. I mean, and especially that we're hearing from Ghana's finance minister that this draft MOU is potentially going to happen in May. And because really this is the next tranche, this is the next step for Ghana in their talks in restructuring their debt. And this has been really ongoing talks that they've been having, and they've hit a snag over the past few months. So the fact that he sees potentially this draft MOU coming with some of Ghana's biggest creditors, including China and France, is very significant. Now, what happens next is really where these talks go. You know, they're in this $3 billion program with the IMF, and they had hit a snag because there were just disagreements over what exactly these haircuts would be between the country and also the investors. And so the question is, what are the haircuts going to look like? Are they going to live up to what the IMF is approving of? And will this then unlock this next tranche of funds for Ghana? Now, if we just talk about more broadly what we're seeing within the region, the IMF did paint a rather rosy picture, which is pretty good for the region considering the past few years. We heard from the IMF Africa director who talked about his expectation that there are going to be bright spots going forward for the region, and especially if we think about a lot of the risks that are in play, including a stronger dollar, and of course we're seeing a lot of geopolitical risks. But he still believes that in the long term, this could be good. They actually said that the economic outlook for the region should nudge up to 3.8% this year and 4% in 2025, which is significant. But the one downside, maybe the one criticism that we did hear from the IMF is specifically about Nigeria, which of course is a big player in this region. Take a listen to what Abebe Salisi told us.
For a country like Nigeria, Africa's most populous country, with all of those development spending needs, we think it's problematic that tax revenue to GDP is only 8-9%.
So that was just a bit of what he was talking about with Nigeria. But still, on the long term, he still believes that because this region is so rich in critical minerals that are, of course, important for the green transition more globally, he still sees things brightening up for the region. So hopefully good news there.
OK, Bloomberg's Jen Dabasaja with the latest in terms of Ghana and its debt restructuring plans. Thank you. Coming up, Tesla slashing prices amid slumping sales and swelling inventory. A tough time for Elon Musk. We bring you the details. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks and futures trade higher as Iran and Israel refrain from further escalation for now. Investors look ahead to earnings from the Magnificent Seven and from Europe's banks. US aid passes the House. Ukraine's President Volodymyr Zelensky says billions of dollars in new funding could help Kyiv retake the initiative against Russian forces. Plus, Tesla slashes prices once again amid a drop in sales and its stock price. Well, as the headaches pile up for Elon Musk, eyes turn to the EV maker's crucial earnings reports tomorrow. And it is, of course, a big week in terms of the earnings story, both for US tech, with half the Mag 7 reporting, Tesla, as we said, reporting on Tuesday, but also European banks in focus for us today as well. We check in on the markets on a day when there is a bit of relief, it seems, permeating across asset as well, with the upside coming through for equities and a little bit downside coming through for those haven assets, the likes of gold, oil and the US dollar. European futures then pointing higher by 0.3%. The FTSE 100 up by 62 points so far in the session. We look at the energy story as well, given the oil has come off a little, see how that feed through into the FTSE 100 at the start of trading at 8 o'clock UK time. S&P futures holding just above that 5,000 level, pointing gains of 0.3% after a very challenging week last week. Nasdaq futures pointing higher by 0.5% after the worst week for the Nasdaq 100 since November of 2022. Looking to repair some of those losses, at least gauged on these futures. Let's flip the board and look cross-asset then as we focus on the Treasury space. It's a big week in terms of auctions, so that will test the appetite out there for these US bonds. The 2-year above 5%. Currently, the US 2-year, and yields are edging higher again as some of the geopolitical moves unwind in the Treasury space. Euro dollar currently up 0.1%, reflecting a little bit of softness coming through for the Bloomberg dollar, or at least the US dollar, I should say. Gold at 2,370, dropping 0.9%. Brent at $86 a barrel, down 0.9. Amrita telling us she sees a little bit of near-term further softness for oil before some upturn later in the year. That's a check cross-asset then. Let's get to what's happening in terms of the implications of this bill that's working its way through the US political chambers and what it could mean for TikTok, because that bill forcing TikTok's Chinese owner, potentially ByteDance, to divest its ownership is on a fast track now to becoming law in the US. The legislation was included in that aid package then passed by the House over the weekend. That package is expected to be signed off by the Senate and then, of course, given the green light by the US President. Let's bring in Bloomberg's Rebecca Chung-Wilkins for the details on this with the TikTok component in focus. Rebecca, TikTok, of course, spent years lobbying in the US. It seems that hasn't really worked out for it, at least so far. The concerns about it being a national security risk remain. Their efforts have failed, it seems.
Yes, absolutely. That looks as if that's sort of the place that we have now arrived at. As you say, various US actors have tried to roll out restrictions or curbs on TikTok to tackle that perceived national security risk, including by President Trump, of course. But it seems like this framework, this sort of divest-or-ban framework, was able finally to thread the needle when it came to seeking enough bipartisan support to take it through. And we have very much moved from this sort of phase of discussions around what the US can do, what it should do with TikTok, to a process of legislation and, ultimately very likely litigation, because TikTok itself has said it's going to exhaust all possible channels, all possible legal channels to push back against this.
Rebecca, what has been, if there has been one, the reaction from Beijing so far? And we haven't had one yet. What could we expect Chinese authorities, their response be to this piece of legislation?
Well, Beijing has so far been quite robust, at least in its rhetoric in pushing back against this. It's previously accused the US of bullying China, for example. But it is important to set this broader context that Beijing, by and large, amid, for example, the plan by Biden to potentially raise tariffs, triple tariffs on steel, for example, on Chinese imports of steel, all of the other EU probes into unfair practices and subsidies and so on, Beijing throughout this has remained relatively restrained, relatively muted. And it's in part because ultimately, bigger picture, China is relying on demand from the US and that demand and boost and support for its exports to try and help with growth. So although sort of front of house, we see Beijing being a little bit more sort of reserved. Behind the scenes, we do know that it's been reported that the Chinese embassy, for example, has tried to send its staff to set up meeting with congressional members of Congress and try and sort of lobby from that side. It does seem, as we've said, that, however, those sort of efforts are failing so far. But yes, I think in terms of a Beijing response, I don't think we're going to see sort of too much fire here.
OK, Bloomberg's Rebecca Chung-Wilkins on the potential Chinese response to that piece of legislation that could see, of course, the divestment of TikTok from its parent company, ByteDance. Thank you very much indeed To the fortunes now of Elon Musk and Tesla. It's been a tough couple of weeks. Elon Musk postponing a trip to India. It was meant to have happened over the weekend, blaming pressing issues at Tesla, which spent the weekend cutting prices for its cars and its driver assistance software. This ahead of earnings due out tomorrow that are expected to confirm a first revenue decline for the company in 4 years. Musk has also staked the company's future on a next-generation self-driving vehicle concept called the robo-taxi. For more on today's Big Take, then, let's bring in our global business editor, Peter Verco. Peter, what is going on at Tesla?
It's a fascinating question, Tom. It's been a wild week at Tesla, even by Elon Musk's standards. You know, it started last weekend with those swinging job cuts that we saw. That was sent out in a late-night email to Tesla's global workforce, telling them that 10% of the workforce was going to be cut. We've had reporting that people were turning up at work for their shift the next day and they didn't know whether they had a job or not. In the following week, we saw the seemingly strategic pivot towards the robo-taxi, attempts by Tesla's board to revive that $56 billion pay package for Elon that was struck out by a court in January. Friday was a recall of the Cybertruck for an accelerator pedal issue, and then the news didn't stop on the weekend. We had price cuts in the US, price cuts in China, price cuts in Europe, the cuts to full self-driving, and that last-minute postponement of his planned trip to India this week. So it really puts a spotlight on the earnings call on Tuesday. We know the earnings are probably going to be disappointing given the slump that we saw in first quarter sales. But I think what analysts and investors are really looking for now is some clarity on the strategy of Elon Musk and Tesla going forward.
There's been some debate, and this is unpacked in today's Big Take, which is really, really worth a read. Peter, when it comes to the debate internally within Tesla about whether or not to go for the cheapest potential model, a true mass market Tesla, $25,000 or so, or the fully autonomous option that he seems to be pushing for. Talk to us about the debate, the nature of that debate, and what it tells us about the tensions within Tesla and its future.
Yeah, well, very interesting. 3 months ago on the previous earnings call, Musk was really talking up progress that they'd made on this $25,000 car, the so-called Model 2. And that's really seen by investors and analysts as a really needed measure by Tesla to fill that sales gap that they've got and to start to compete at the lower end of the market, where we're seeing companies like BYD really coming out with a whole range of decent EVs at those lower price points where Tesla just can't compete. But now, and you know, this is his comment during the week that Tesla was going to go balls to the wall with an autonomous vehicle and a robo-taxi. It seems to be a big pivot. Nobody's really nailed autonomous driving yet. You know, even Tesla that markets full self-driving, but we know full well that it's not full self-driving, it's not autonomous. It still needs constant supervision by a driver. And there really does seem to be tension within the company over whether swinging away from the Model 2 mass market car towards the autonomous robo-taxi is the right way to go.
OK, global business editor Peter Verco. Really, really fascinating in terms of the travails, for now at least, of Tesla. We look ahead, of course, to that all-important earnings story as well. The details coming through on Tuesday, and Peter setting us up brilliantly for that with a big take worth reading today, certainly worth your time. To the European earnings space now, where Europe's biggest banks are picking up the baton this week after mixed results from Wall Street. According to Bloomberg Intelligence, with sector stocks trading near a 6-year high, the outlook for lenders may be right for a reset. That's if earnings disappoint. Of course, we continue to weigh up what ECB officials have been saying about a potential cut in June, what that could mean for net interest margins as well. Let's bring in Bloomberg Chloe Melly now for the details on this, a preview. Chloe, what are the main themes to look out for this week when it comes to European earnings in the banking sector?
Yeah, so it's a very busy week for bank earnings this week. And as with the last couple of quarters and probably with the next few. The main theme is really the slowdown in net interest income, and that is even despite the fact that there's been the expectations for rate cuts have been scaled back a little bit. The net interest income is going to be quite sluggish for most, if not all, lenders reporting this week. So that's kind of across the board. And if we look at specific banks, for companies like Deutsche Bank, BNP, and Barclays, the performance of the investment bank is also going to be quite important, and any kind of indication that the activity is picking up a little bit is going to be welcome.
Yeah, has deal flow picked up? Are there more IPOs in the pipeline, more fundraising going on? So we'll watch all of that as well. In terms of the broader outlook for the banking space in 2024, what are the kind of potential headwinds or tailwinds for the sector that you and the analysts will be looking at?
So related to this idea of net interest income slowing down is obviously the idea of cost control. So there's this metric called operating jaws, the difference between revenue growth and cost growth, and that is likely to turn negative for quite a lot of banks. So that's going to be in focus. I think it's about 15 out of 25 big European banks are likely to slip into negative jaws this year, compared to just 3 in 2023. And, you know, there's also this idea of rising loan loss provisions, so that it will not be necessarily seen in the first quarter, but the gradual increase will come in through 2024. And there's also, as you mentioned at the beginning of the conversation, the stocks are trading at a near 6-year high. So there could be a reset and some revenue downgrades if earnings disappoint a little bit.
Chloe, thank you very much indeed. Setting us up for a big week, of course, for European bank earnings and what to watch for. Chloe Melly with the details and the preview there. Coming up, the greenback is back. If you hadn't noticed, going more than 4%, gaining more than 4% year to date. A little bit of softness coming through in the session today, but of course the upside has been there and it's been pronounced. We discuss the dollar's dominance next, the ripple effects and whether it's expected to continue. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the dollar is lower. It goes to most FX majors this morning. But, of course, the greenback has been on something of a tear year to date, up about 4%, of course, in that time frame, fueled by rising geopolitical risks and shifting views, of course, on US interest rates. And those views really came into focus last week with the rhetoric coming through from those Fed officials. And, of course, what we heard from Jay Powell, higher for longer, seems to be the new mantra. Whether or not we do indeed get any cuts this year as well, all being weighed up by these FX markets. Let's bring in at this point Michael Pfister, then, FX analyst at Commerzbank. Michael, I want to start with the top-line view on the dollar. We heard from one of the top strategists at Vanguard saying essentially there is no option at this point but to buy the greenback. Do you agree with that view?
Yeah, I totally agree with that. Right now it's hard to find any reasons to bet against the dollar, actually. We've seen quite a rally over the last 2 weeks after the inflation surprise. And on top of that, we have a strong growth advantage and a very hawkish Fed, so it's hard to imagine any reasons to sell the dollar, actually.
How vulnerable is the euro within that context? You see further upside for the greenback. We've heard from ECB officials reiterating that they expect to go with the first cut in June. Does that leave the euro vulnerable, and how does that percolate through the exchange rate then?
Yeah, I would say the euro is one of the most vulnerable currencies against the US dollar right now, because we have a very dovish ECB, which actually wants to cut back-to-back right now. So they are talking about a few more rate cuts this year. And on top of that, we have a disinflationary process, which is making far more progress than in the US. And a very weak real economy. So right now, the euro is very vulnerable against the US dollar.
What is the level that you're targeting? Is parity something that we should be factoring in for this year, or is that going too far on euro?
I think the parity is going a bit too far, because the euro is already very weak against the US dollar. So we are targeting like levels around 1.04. So a bit above parity, but very close.
OK, 104, we're currently at 106, so a little bit more softness is expected from you and the team at Commerzbank. What other major currencies are vulnerable to the wrecking ball of the US dollar at this point?
Well, we have the Swedish krona, where we also have a central bank which is very dovish right now. So they were already talking about first rate cuts in March, which they did not deliver in the end, but actually they are also very vulnerable right now. And the real economy is also suffering over there, so they will probably start cutting in May already, which is even further ahead from the ECB. So also not a good sign right now.
Okay, euro, Swedish krona. What about the Japanese yen? We had the BOJ. The meeting is expected on Friday. It's expected to be a live meeting, but the estimates are that they're not going to go again with another hike at the meeting this week. We'll see how that transpires, of course. Intervention watch is in focus when it comes to the Japanese yen. Is there a support level for the yen that you're looking at? Is 160, 170? What are we looking at in terms of further softness for that potential move?
So we are expecting 160 towards the end of the year. So further yen weakness. Because right now we can't imagine Bank of Japan hiking even more. The inflation is very low and we see no reason to hike in the end.
Is that assuming that they intervene? Is that assuming that intervention doesn't work?
So they could intervene, but it's probably only a leaning against the wind. They do not have the firepower to keep the yen stable at 155 or even lower.
OK, so targeting 160 on Japanese yen, intervention's not really going to cut it for that currency. We turn back our focus to the UK and the pound. In light of that dollar strength then, there's concern about the inflationary impact here in the UK given our need to import. When it comes to your view on sterling, how is that shaping up?
So we see the pound like in between the euro and the US dollar. We have higher inflation and more hawkish central bank, but the real economy is not very good. So right now, probably the Bank of England probably wants to cut sooner rather than later, but it's just not possible right now. And that's why we expect them to cut later than the ECB, but before the Fed. And this is why we position the pound in between them.
We have an MLive Pulse survey for the week where we gauge the views of various strategists and others within the market. And the question for this week is which will move rates by more in 2024, the Fed or the BOJ? Where do you land on that question?
Probably the Bank of England, but not by much.
So I think the Fed or the BOJ, but you actually think the BOE is going to move rates more?
Yeah.
OK. Within that context. And in terms of the sequencing, how are the team at Commerzbank right now thinking about the sequencing of cuts? You buy into the view that the ECB goes in June. Where does the Fed land? Where does the BOE land?
So we now expect the Fed to start cutting in December, which is quite late, and the Bank of England in between them, so in August the first time, when new forecasts are published, and inflation makes more progress. OK, not until December, then, for the Fed, is the view in terms of the first cut coming through there. In the commodity currency space, we've obviously looked at the run-up in oil in the last couple of weeks. It's come off today, given there's been a lack of geopolitical catalyst over the weekend. In the commodity currency space, how are you thinking about the role that China may play if there's an inflationary move there? That's a good question. So we've seen some good growth rates from China recently, which is probably an advantage for currencies like the Australian dollar or currencies that are largely in relationship with the Chinese economy. So there we are seeing a positive impact. But further than that, I would not expect much right now. OK, Michael, thank you very much indeed for bringing the analysis this morning in the FX space, of course, with dollar strength in focus for us today, the ripple across the FX space, of course. Michael Pfister, FX analyst at Commerzbank. Thank you. Now for some of the other stories making news this Monday. Bloomberg learning that BNP Paribas has hired close to 30 people to launch a new securities operation in China. After receiving regulatory approval, the French bank will build out its brokerage, research and asset management units. This comes as the lender opts out of investment banking amid a deal slump. US Commerce Secretary Gina Raimondo said Huawei's latest phone shows that China remains behind on cutting-edge chip technology. Huawei unveiled a smartphone powered by a homegrown chip last August. In an interview with CBS, Raimondo downplayed the company's claims of a breakthrough, vowing to take the strongest possible action to protect US national security. And UK Prime Minister Rishi Sunak is pushing to pass a law declaring Rwanda a safe country for the deportation of asylum seekers. The bill in the House of Commons today seeks to circumvent a Supreme Court ruling from last year. This comes as Sunak makes a 48-hour Europe trip to defend his record on defence and regain momentum 10 days ahead of a key set of local elections. And Olaf Scholz says he is optimistic on his country's economic prospects. Speaking at a major trade fair in Hanover, the German Chancellor highlighted record employment and slowing inflation thanks to falling energy costs. The potential economic turnaround so far has not helped the electoral prospects of his Social Democrat Party. There's plenty more coming up. Stay with us. This is Bloomberg.
We're hearing it's all big tech, right? That's what some of the headlines are this quarter is about big tech.
Big tech has great balance sheets with a lot of cash and very little debt.
Mega cap tech companies that are generating extraordinary amounts of cash flow, they're still actually doing very well.
Tech is a big part of the quality story.
And we still would expect for this quarter in particular for many of those companies to lead on earnings growth.
You look going out, 1, 2, 3 quarters. I mean, it is going to start broadening out.
You can't have tech be the only thing that does well if you're starting to see economic weakness in other places.
We're just ramping up earnings season now, and I think that's going to be a good distraction for the market to be able to sort of have a look what's actually going on to see whether the lofty valuations are actually supported by the fundamentals.
Bloomberg TV guests, of course, on US tech earnings. A major week for those earnings with half of the Magnificent Seven, the so-called Magnificent Seven at least. Questionable whether Tesla deserves to be within that bracket. Reports this week. Tesla earnings coming out on Tuesday, so maybe they can push back on that view. Here's the broader picture in terms of the views, at least the guidance, the outlook when it comes to earnings per share, EPS, for these companies, the S&P. In, of course, quarterly, you've still seen gains in the quarter in the stocks. Even though you've seen that downside pressure particularly pronounced last week, you've still seen the upside year to date in terms of the stock performance, the S&P. And the earnings outlook has actually been revised higher, 3.69%, 3.7% is that blended forward earnings per share view then in terms of the S&P. Within that, of course, tech is playing and doing the heavy lifting. Let's flip the board and see how things are shaping up in terms of the RSI, the relative strength then indicators coming through. That momentum, of course, has faded. The momentum around the S&P has faded, and you saw its worst week in over a year last week. The RSI now is closing in on overbought territory, levels last seen in October of last year, which did mark the bottom at that point, and then you saw a turnaround. Are we in a similar position right now, given that RSI is pointing close to oversold, not overbought, oversold territory, I should say, and will the AI catalyst kick in this week and propel things higher? That is a key question for us this week, whether or not these companies are able to implement at the structural level some of these AI gains. Don't miss our exclusive interview, by the way, with the chairman of a luxury fashion house, Valentino. That's at 9:30 a.m. on The Pulse. Markets Today, though, is next. Stay with us. This is Bloomberg.